All right, good evening, everybody. It is Tuesday, the 27th of September. The markets today had a massive turnaround from way into the green and finishing in the red. But did you see the 10-year yield and did you see the US dollar and what happened as they turned? Let's talk about it. I'm your wealth guy. Let's talk money. Let's talk market wrap-up. All right, everybody. So first things first, I just want to thank you for tuning into the channel again today. I really hope you like what we have to say. If you do, and even if you don't, feel free to comment down below. I really want to hear what you have to say and your thoughts on the market, where the economy is headed and where the markets are headed, at least for the near term. But let's talk about it because today the market saw a massive swing. When we opened this morning, markets were up about 330, 350 points, at least the Dow was, before we ended up pulling all the way back in the mid to late afternoon, closing in the negative about 125 points. Now, that is a massive turnaround. Powell this morning did create some measure of confidence in the market. We did have some confidence or consumer confidence numbers that came out a little bit better than expected. But one thing we also saw was that new home sale values have dropped significantly and continue to plummet. So a little bit of mixed economic numbers there. Now, consumer confidence is partially fueled because of a drop in the price of crude and oil. Now, that being said, it will be a short-lived positivity or a positive number in consumer confidence. I anticipate that this will come down, especially as we enter the winter season and fuel and energy costs start to skyrocket once again. But let's have a look at the rest of the market because overall the market, although in the negative and in bear territory, wasn't frightening. As I said, the Dow was down about 125 points. The S&P 500 down about 7.75. And tech actually finished in the green about 26 points. Now, overall, we are still in bear territory, and this is still concerning, and here's why. The previous bear territory level was actually a level of support. We saw a bounce off that, a lot of purchasing midsummer, and that caused a little bit of a bump or a dead cat bounce at that point, where we saw a rally midsummer that lasted till about mid-August before everything turned around and started dropping aggressively once again. Now that we have gone beyond that bear territory level of support, we are now dipping into approaching the 2-year low. Now, if we do not find any levels of support there, we don't bounce with any significance and move to the upside, we can anticipate that by breaching that 2-year low, we will go much lower. Again, back to that 20 to 30% from the highs or from where we currently are now. So overall, about 40% off the highs. Now, I also anticipate that there is really no significant level of support to the downside. In fact, we don't even know where the bottom is and where it could potentially be. Analysts out there are throwing out numbers that really have some mathematical support, but in truth, there is no bottom. We could very likely see an 85% drop. I don't believe that'll be the case. However, it is not outside the realm of possibilities. So what does that mean for investors? Well, for the day traders, not a heck of a lot. They're day trading. They can manipulate as they need their portfolios as they need to. Swing traders, same thing. If they're holding on to positions, very easy to hedge against them. But really what we're looking for are the long-term investors, the 401ks, the RSPs here in Canada. These are the people that need to actually watch their portfolios a little bit closely, especially if they're approaching retirement or in retirement and using their savings as a source of income. Because here what we really need to take a look at is if the markets continue to drop, specifically for those who are receiving income from RIFs here in Canada, for example, one thing we do need to pay attention to is that if the markets do drop another 20 to 30% from here, that will absolutely decimate your portfolio and you will have very little chance of actually recovering back to the highs of where we were. And simply because you are withdrawing at a percentage rate, 3, 4, 5% from your portfolio, unless you're above that as well, just to maintain your lifestyle, factoring inflation, of course, there as well. So you will eventually need to start taking more, not allowing the portfolio any time to recover. So at this point, it may be advisable, I would talk to my advisor if I were you, at possibly moving my portfolio into something more secure, something along the lines of a daily interest, a GIC, or short-term cash or interest-bearing position, just to preserve capital at this point, as we don't know what's going to happen for the near future. Not trying to time the market, not suggesting you should do that, but definitely something you should converse with your advisor. Now, that being said, let's have a look at the rest of the market, because there's some important things we need to take a look at. Number one, the 10-year yield. The 10-year yield started in the red this morning. Positive sign for the market, again, supporting that upside swing. The US dollar, same thing. We saw it in the negative. How did we finish the day? Well, the 10-year yield bounced right back up about 7.5%, actually just over 1.75%, so 1 3/4. The US dollar also finished in the green, now comfortably sitting over 114. So overall, both indicators suggesting that there is still an additional downside pressure as the bears continue to move the markets downwards. Now, taking a look at the 10-year yield alone, this is becoming very concerning. Currently, the 10-year yield is sitting just shy of 4. So it's at current number is 3.949. I do anticipate that this number will leap over 4. What are we looking for here? Well, we are looking for aggressive moves to the upside, or continued aggressive move to the upside. And I'm not talking about seeing a 20 basis point move or a 30. I'm talking about we're going to see 40, 50 basis point moves. Very, very aggressive. Those are 5-6% moves overall on the daily, and we will see that over multiple sessions. That is concerning, because I already believe we may no longer be in a controlled environment for the debt market. And I think Federal Reserves and central banks are beginning to panic. If we see that aggressive move to the upside, that is the sign that the markets are in dire trouble, and we can expect that the markets are going to fall. And that's the plan. That is absolutely the design at this point. And as much as central banks want to maintain some level of stability for now, so that they can continue with their agenda of buying and selling and owning everything, essentially, if they can't control it, that is a sign to leave. And in fact, we are receiving many, many, many warning signs here from the 10-year yield, telling us that the markets are under extreme stress and pressure to the downside. Let's have a look at cryptocurrencies, because on the day, most cryptocurrencies did finish pretty well in the red, very slightly, after having a tremendous day overall. Bitcoin currently just back at 19,000. Ethereum currently sitting at 1320. If we take a look at precious metals did finish in the green overall, but well off the high. Energy, same thing, did finish in the green, but agriculture did suffer a little bit. Overall, very mixed across the commodity sphere. Now, I do anticipate, as per usual, that in the future, at least in the near future, we can expect energy prices to rise. I do anticipate that precious metals will also begin to see a rise as well. Not too sure if that's going to happen immediately, but we can certainly expect that. But that's it for today, everybody. Just wanted to run a quick update. Where do I think the markets are going tomorrow? I don't know if we're going to see a sustained bounce here. We are due for a little bit of an upswing, but I think the pressure from the bears, and again, we're going to have continued reporting this week that'll probably show us numbers that aren't too pleasing. There was some Fed discussion today that are talking about, again, continued interest rates that are going to be increasing over time, inflationary numbers that are expected to be high and here to stay to a degree. So I'm not really very positive on the markets overall, but we are due for a little bit of a bounce. Even if it's a positive day at only 100 points, we are due, but I'm not expecting much from this market. Even if we do get that, I think the downside pressure is just a little too strong for now. I will see you all tomorrow morning at the opening bell.